Hello everyone, this is Dr. Mihir Shah once again with another video. In this video, we are going to solve November 2024 University question paper under subject Commodity and Derivative Market. Again, a very important video for all the TY BMS Sem5 student. In this video, we are going to solve all the practical problem sum that had appeared in this particular question paper under the subject Commodity and Derivative Market. So let us see what are the questions that had appeared in this paper and what were their answers and what was the easy way to solve them. Okay, the most appropriate and simplest manner to solve it. Chalo, we'll start one by one. The first question: the spot price of gold is 1 lakh, locker rent is 16,000 per annum, and insurance is 9,500 for 6 months. Interest rate on borrowed fund is 12% per annum, and calculate the fair value of 3 months future contract compounded monthly. Now, whenever such questions are given, remember this is compound. 3 months is the period, and they are giving you two things, per annum and for 6 months. So anything which is per annum, we'll have to take into 3 divided by 12, like only for 3 months, and anything which is for 6 months into 3 divided by 6, we'll have to do. So fair value is spot price into 1 plus r upon 12 raised to the power of n as per compound interest method. So spot price was 1 lakh, 16,000 into 3 divided by 12 is 4,000, and 9,500 ka half is 4750 into 1 plus 0.12 upon 12 raised to the power of 3. We multiplied it and divided it, so we got 1 lakh 8,750 plus 1.030301. When you multiplied, you got the final value as 1,12,045.234. So this was the fair value of future compounded interest manner. Okay, very simple. Just have to apply the formula. Only have to remember anything per annum per 6 months. If the period is of 3 months, then take it everything have to convert it into 3 months. Okay, chalo, you all can go through it once. Okay, now the next sum. An investor took 2 position in future market. He sold 1 future of Infosys stock. The future price was 8,500. On the expiry, the cash market price was 8,000. He bought 2 futures of Jindal and expiry price was given. Find the profit and loss for a lot size of 50 size in one contract. Also draw a payoff diagram for the same. So this question was given. This is basically hedging related sum, where you have one part on selling and one part on buying. So sell and buy, both parts are given. So see, now when such kind of sums are given, we only have to solve in particular stepwise. Very simple sum. First, we are going to take off Infosys Limited. The steps are very simple. Okay, first, whenever you get such kind of, always write the contract. Write your contract price, write your settlement price. Contract price में contract मतलब what is the thing are you doing in the sum? You are selling. Starting में you are selling. So I'll write your selling price. The price was 8,500. So on the contract, if you are selling, on settlement you will have to buy. Meaning if it is selling, you have to buy. If it is buying, it will have to sell. So buying rate is 8,000. On the cash is given. Profit and loss ka formula is very simple. Selling price minus the cost price. So selling is 8,500. Okay, cost was 8,000. So 8,500 minus 8,000. So it's like at current price I sold for 8,500, and in future I'll have to buy. So I'm still gaining 500 rupees ka profit. So that is profit for per 1 unit. Now we need to find for the entire. They told you ki you have taken for 1 future of Infosys. So that is 1 future. 1 future contains 50 size. Like the one contract contains 50 units. So 1 into 50, and per unit ka profit is 500. So into 500. So 500 into 50 into 1 is rupees 25,000. That's the profit. So that is how you all had to solve this sum. Now along with the payoff, diagram payoff, see, remember the diagram is very simple to make. This is a diagram. Step number 1, whatever is your contract price, write it down, 8,500. Then settlement price 8,000, settlement is lesser, so 8,000 will come on the left side. On the settlement date, whatever it is, if it's a profit or loss, mark that point. Now on the settlement date, we had a profit of 500, so we marked it profit of 500 on the set. Marking is always on the settlement date, okay? 500, and now from that, just make a line crossing to the other level. This is your payoff diagram. Okay, so you can go through it once. Very simple. This is only of Infosys. Okay, we even have to do for the second Jindal still, but you can go through the sum first. Okay, now same way we will solve for Jindal. Now here in Jindal you bought 2 futures, so starting is buying for 20,500. So the moment you buy, on the settlement date you will sell for 22,500. Formula is selling minus cost, 22 minus 20, so there's a profit of 1,500 per unit. So total profit will be, you're taking 2 futures, so 2 into 50 into 1,500, which comes to 1,50,000 rupees. Same thing we need to draw. So first we note down the contract price, then we note down the settlement. On the settlement you had a profit, so profit of 1,500. We pass a line which has to move towards the contract price. So this is how you all had to solve the sum based on the settlement price, contract price and payoff table. So this is based on that future hedging sum. Okay, very simple, just have to follow that particular steps. You all can go through it once. Okay, chalo, the next sum now. The spot price of silver is 9,500, locker rent is 1,200 per annum, insurance 2,500 for 6 months, interest rate on borrowed fund is 10%. Calculate the fair value of 3 months future contract compounded monthly. Again, compound base, you need to find the fair value. Formula is same. Fair value is spot price into 1 plus R upon 12 raised to the power of n. Spot is 9,500. 1,200 per annum I need for 3 months. So 1,200 into 3 divided by 12, which comes to 300. 2,500 is for 6 months, we need for 3, so half of that is 1250 into 1 plus 1.1 upon 12 raised to the power of 3. When you add up this, it becomes 11,050, and this is 1.0242. You multiply, we get 11,317.41. This is the fair value of 3 months contract. You can go through it once. Okay, chalo, now the last sum which had appeared in the paper. Ria shorts a call option. So again, this is call option seller's payoff sum with an exercise price of 1,000, premium 30 rupees, find the profit or loss if the spot price on the expiry were given as follows, and also draw the payoff diagram. Remember, spot price noted down, exercise price we noted down. Remember, when it's a call option, seller's payoff, so the intrinsic value up to the price when both are equal will be 0, and thereafter there will be negative. Premium you're going to sell, you're going to receive, so positive 30. Okay, you multiply, sorry, then now it's call premium minus intrinsic value, so 30 minus 0, 30 minus 0, and so on. So we will get the profit and loss. 30 minus 10, 20, 30 minus 20 is 10, 0, negative 10, and negative 20. This is how you'll have to create the payoff table. Along with that, the diagram. So first you note down the spot rate, intrinsic value up to 1000 0, then it is negative 10, negative 20, negative 30, negative 40, negative 50. Profit is starting with 30, 30, 30 till 1000, thereafter is 20, 10, 0, negative 10, and negative 20. So this is how you will have to draw callers option, sellers payoff diagram and the table to find the profit and loss. Okay, so I hope everyone have got this. You all can go through it once. Okay, chalo, I hope everyone have understood all the practical sum that had come in this paper. So with that, we will be ending this video here.